Hey everybody, Cole Long here. Just wanted to bring some information regarding business banking with some side notes on budgeting. I know a lot of the time that entrepreneurs get into business, they really don't know how to manage their cash flows or plan for growth opportunities and pay taxes. And the accounts that I'll be talking about will help you do that, and some of the budgeting procedures and principles will also help with that as well. 4 accounts I'll be talking about would be your operating account, your profit account, capital expense account, tax account. A little bit about those accounts. You have your operating account, which is going to be paying all your operational expenses out of. And I also mentioned the payroll account. I apologize. That would be separate from the operating account. So to recap, you'd have your operating account, payroll account, tax account, profit account, and capital expense account. So I believe that's a total of 5 accounts there. So yeah, operating account, you pay all your operating expenditures out of. A payroll account, all of your payroll expenditures and benefit expenditures out of. And then you have your profit account, which you'd be doing profit distributions or dividends out of. And then your tax account for tax payments out of. And then you have your capital expenditure account or your retained earnings account, which is utilized for purchase of assets and for the utilization of financing internally for growth in the company, however that may look for you. Now, with these accounts in light, a lot of people don't know, okay, how much do I put into these accounts? Well, ideally, aside from the payroll account and the operating account, so that leaves us with your profit account, tax account, and capital expense account. Those 3 accounts, you can delegate a percentage that would be based on your profits at end of year. Now, for me, and what I like to utilize is I like to do a master budget that forecasts profits for the next year based on revenue of previous periods or previous years. I use linear regression to do that, and then I utilize percentages that make up line items on my income statement, a synthesized income statement. So cost of goods sold line items and then operational line items, which help me gear or produce a profit percentage for the year end, which is your EBIT, earnings before interest and taxes. And so with that number that you produce, or that margin, so say it's 5%, you would then delegate percentages based on that margin into those accounts. So say you have 5%, you could then delegate 2% to your profit account, 1.5% to your capital expense account, and then 1.5% to your tax account. What that does is it moves the money aside as revenue is generated to be placed in these holding accounts for their purposes. The remainder, which I'll get to how this process will actually work, the remainder will then go into your payroll account and operation accounts. So on a weekly basis, as revenue comes in, you have a revenue set amount, and then you know, okay, based on this revenue, there's gonna be 5% of this revenue is gonna be profit. And from that 5%, you would then delegate to your 3 different additional accounts, your profit account, tax account, and then your capital expense account. And then the remainder would go into the operating account and then the payroll account for those expenditures. Side note, I would leave always a portion, maybe 1 to 2% from the profit margin to be rolled over into the operating account. And what that means is, instead of taking the whole 5% and moving into those accounts, you're only taking 4% and then divvying them out into those accounts. And what that leaves is extra money going into the operating account for possible cash flow restrictions, and then to just keep as much working capital in that account as possible for purchases, and as I said, restriction cash flows based on the lines of businesses that you may have. So what that produces in general is a system to, 1, pay for our daily operating expenditures, 2, move money into the payroll account to ensure that you always have enough payroll for your employees, and then 3, which is the big picture and some of the most important aspects of this principle, is to move money into your profit account for dividends paid out to owners or shareholders, and then your capital expense account to help fund internal financing for growth in the company, so purchasing assets, improving your workspace. It could go into anything. You could go into training programs for your employees, anything like that that you may need based on your strategy as a company. And then of course your tax account, which is going to be the money set aside to pay for taxes throughout the year or at end of year based on the firm organization that you have for your business, which would be your LLC, corporation, partnership, etc. So hopefully this information helps you. If you have any questions, leave a comment, and subscribe, and look forward to some more videos in the future. Peace.